Greetings, friends of liberty. Peter Schiff, free market economist and owner of Euro-Pacific Asset Management, and son of Irwin Schiff, a tax resistor who died in jail resisting, became famous during and after the Great Recession of 2008 for being one of the few stock market analysts who predicted the coming crisis. Inheriting to a degree his father's contrarian stubbornness, Peter told anyone who would listen when and how the Great Recession would happen. One can only contrast his approach with that of hundreds of others who had drunk Federal Reserve Chairman Alan Greenspan's housing and low interest rate Kool-Aid and could never see an end to the bubble staring them straight in the face. Such ability to see into the future economically is certainly to be applauded and treasured both by economists and potential investors. Let's review the particulars of his predictions around the Great Recession and then turn to examine what he's predicting today about gold and Bitcoin. The American housing market started to decline in mid-2006, the decline accelerating in 2007 and 2008, with housing prices bottoming out in 2012. Schiff first talked about the bubblicious American housing market in August of 2005, saying, "It's very much like the internet market of the late 1990s, and that it's not going to last much longer." In August of 2006, when asked on MSNBC whether a recession was coming and how bad it was going to be, Peter replied, "Whether or not it starts in 07 or 08, it's going to be pretty bad and last not just for quarters, but for years." By the way, economist Arthur Laffer of the famous Laffer Curve, participating in this very interview, said that he didn't believe any of it. The U.S. economy has never been in better shape. Good call, Arthur. Financial analyst Ben Stein, referring to mortgages and trying to minimize the risk, said, "Subprime is a tiny part of the market." Peter replied, "It's not tiny, and it's not just subprime." Fast forward from August of 2005 to December of 2006. Peter said in another market call that today's home prices are completely unsustainable. The other analyst on the panel, one with a thick, especially uncouth Brooklyn accent, responded by literally laughing along with one of his real estate buddies at Peter. In January of 2007, Peter said, "There is a very good chance the recession will start in 2007. It started in December of 2007. 8 months later, in September of 2008, Peter said, "The economy is going to crash." The crash started almost immediately. This is not to say that Peter was right about everything. He also predicted that the government was going to print the dollar into oblivion. We're going to have massive inflation in this country, and there's a chance that it turns into hyperinflation. It's the same type of incentives that the Argentines faced, that the Germans faced in the Weimar Republic. In monetizing the debt, I hope it doesn't get to that worst-case scenario. In other words, when he said in 2006, for example, that what we're about to experience in the next decade will be far worse than anything we experienced in the 1970s with regard to inflation, that was wrong. But Peter was and is right about the long-term slide of the dollar, which, after strengthening, contrary to his expectation, for about 8 months during the Great Recession, around April of 2009, soon resumed its downward slide, which continues to this day. One of the greatest instances of Peter spelling out the coming disaster was when he gave a talk at a meeting of the Western Regional Mortgage Bankers Conference in Las Vegas to over 2,000 real estate professionals on November 13th, 2006. He had made similar comments a year earlier, in 2005. In this 2006 talk, he laid out his whole investment thesis and provocatively said that he was shorting the market. He started by explaining the history of of the bubble. Back in the 1990s, we had a bubble in the stock market. The bubble was created by Alan Greenspan and the Federal Reserve. Eventually, the bubble burst and the Nasdaq lost 80% of its nominal value. In fact, I predicted this in advance when I talked to potential clients in 97 and 98. Well, it happened in the stock market, and it's going to happen in the real estate market. There's very little difference. Alan Greenspan, very far from his Ayn Randian roots, is now a very political person and wanted to help his buddy, George Bush, get reelected. Peter Schiff thus meant that Greenspan kept interest rates too low for too long, leading up to the 2004 election, since he and Bush wanted to have a bigger disaster later because someone else might be in office, instead of letting the market crash earlier in the run-up to the election. And so all that extra money created by Greenie, setting the Fed funds rate so low with interest rates down to 1% in 2004, poured into the housing market, with buyers becoming increasingly reckless. And now, over the next year or two, you've got about $2 trillion of adjustable rate mortgages that are going to reset. Now, where are homeowners going to get the money to make those mortgage payments? It's not like they're sitting on a pile of cash. They're spending 40% of their income on their mortgage now at these low rates. How are they going to be able to afford payments when the rate's 8%, 9%? And so we continued. Since most of us earn our living on discretionary spending, a lot of us are going to lose our jobs because that extra money, that discretionary spending, will be spent in the economy, will no longer be there to fund those businesses that produce those discretionary consumer goods. And so people making those discretionary goods will lose their jobs. In other words, we're going to have a very severe recession as a result of that contraction of consumer spending. Of course, with housing prices constantly rising from about an average of $158,000 in 1999 to $266,000 in 2006, in those 7 years, the psychology of both the buyers and lenders changed. When he noted that people used to buy a house because they could afford it, now they buy a house because they need money, because of the constant appreciation, the audience laughed in recognition. If you were renting in California, you were an idiot. You were throwing your money away. In fact, many house flippers asked themselves, why work? Because they could withdraw so much equity from the increased value of the house annually. And after a while, since lending standards kept loosening, anyone could get a loan, such as one of these liar's loans that you guys come up with, where they say my income is $150,000 a year. In contrast, in the good old days, all the way back in 1990, there was a lot of scrutiny, a lot of soundness in the lending practices. They wanted the borrower to fully document the loan. I'm not just going to accept your word. Well, how does the lending industry work today? You've got this huge moral hazard built in, and a lot of it was created by government. Next, in his speech, he focused on the more risky part, the subprime part. The way the subprime market works, 65% of the subprime mortgage market, stated income, no documentation, negative amortization. 65% of these are repackaged by Wall Street and rated AAA. AAA! How can that be? Well, the reason is Wall Street creates these tranches of collateralized mortgage obligations, $1 billion worth of mortgages. And the riskiest subprimes, of all the subprimes, the worst 1% of the tranche, that piece of paper is rated BBB minus. That piece of paper should be rated F. So what did he think was going to happen? The bottom is going to drop out of the subprime market. You're going to start to see a big drop or big rise in interest rates, and that whole market is going to shut down. It's almost like a self-perpetuating spiral. So if you think there's a high inventory now of houses, wait a while. But the bigger problem is how intertwined the economy and the stock market are. Once the bubble bursts, cutting interest rates won't stop it. So having seen how well in some respects Peter called the Great Recession, how he's among the very few who saw a big part of what was coming, let's turn to his present predictions about gold and Bitcoin. Number 1, gold. Peter is known in the financial community as Dr. Doom because in general, he expects the worst to happen. And being a free market economist and seeing the enormous increases in the U.S. national debt occurring annually, he naturally and constantly believes that gold is the play to make. And at some point, I would say he's got to be right, since at some point the U.S. dollar will lose a catastrophic amount of its value. So believing this, from 2021 on and even earlier, Peter's been recommending that gold mining stocks can be a great buy because they're leveraged to the price of gold. And that's because, since their mining costs are relatively fixed, if the price of gold rises, most of that rise will be pure profit to the miners. So, for example, if you had bought a basket of 10 premium mining stocks at their general lows in March of 2024, by now, 2 years later, the price of gold having about doubled, the price of Newmont mining would have increased 3 times, Barrick Gold 3 times, Agnico Eagle 5 times, Franco-Nevada 2.5 times, Wheaton Gold 3.5 times, Anglo Gold Ashanti 4 times, Kinross 6 times, Goldfields 3 times, Kerr Mining 8 times, and London Gold 6 times. So the reasoning behind this play is very simple. At some point, the dollar is going to be toast. So if you own precious metals or precious metal miners, you'll be staying out of dollar-denominated assets and very likely increasing your net worth significantly when the big one, the financial earthquake whose tectonic plates are coming closer and closer to slipping, finally arrives. Number 2, Bitcoin. In my own view, Bitcoin is like present government fiat money, pure paper money, in that it has nothing of real value backing it up. But unlike government fiat money, where in former days the printing presses or now a digital keystroke can, like Buzz Lightyear famously said, expand the money supply to infinity and beyond, Bitcoin's value is not capable of being inflated away because of the blockchain technology. But in the end, it doesn't matter if its present speculative value can't be inflated away, since there is no real value there anyway. It's all a monetary illusion. Imagine the following hypothetical. A 500-pound meteor lands on Earth, made purely of a newly discovered but economically useless metal that we'll call elanite. So it's true we could break that meteorite up, making little coins of elanite out of it, and assuming no more elanite meteors fell to Earth, the money supply would not increase. But since elanite has no value, the fact that its supply is fixed is irrelevant. Peter shares these beliefs about crypto and Bitcoin and has said so over and over again. That, number 1, Bitcoin is a fake asset. Number 2, a scam and fool's gold. Number 3, that Bitcoin investing is a bubble. That gold is eating Bitcoin's lunch, which is true momentarily. Number 5, that crypto is a Ponzi scheme. And number 6, we may have a cryptocurrency crisis before we have a dollar crisis. These statements all seem true or reasonable statements to make. At which point I would conclude that, just as Peter was proven largely right about the causes of the Great Recession, so too will his statements about gold and crypto prove. That is my prediction. Happy that in my day and age, the British government still appears to believe in sound fiscal policy and in backing its currency with gold and silver, I bid you well and remain the Scarlet Pimpernel.